This is Gord McCallum and the very first Canadian Mortgage Hangout on Google+. I've got with me Scott Dawson from BC and Jackson Middleton of Regina. I've got with writers Scott Dawson from BC and Jackson Middleton of... And we got a feedback problem because Jackson's watching the YouTube stream live. So.
I didn't know I had it on! Yeah. Okay, so like the first time, and I'm a chump. I love it. There we go.
That's all right. Those are beautiful headphones. So we wanted to just give this a shot. A, first of all, because it's pretty cool technology, but second, now we've got a reason to do this, and welcome any other brokers coast to coast to join us. Let's talk about the mortgage rule changes today. Scott, what do you think?
Well, we were kind of chatting before you joined us with Jackson here. That's how we kind of hooked up. You know what? I think I'll reiterate it. I'm for them. I mean, I think long term, it's going to be a definitely it's the right kind of prudent decision. I think by the finance minister. We'll have probably a little bit of short term confusion. I think was one thing we kind of touched on a little bit, but I think for the long term, it's a good thing.
Jackson, what would you echo that, or any other thoughts on the changes?
You know, when I first saw the changes last night, I kind of saw that they kind of leaked out a bit, and that changes were going to be happening. And you know, the first thing I thought was it's going to be very, very difficult to qualify the first-time homebuyer in our Saskatchewan market. I really wasn't for the changes. Kind of thought through it, did a lot more research, went to the Government of Canada website, saw a BNN video, saw everything that was going around on Twitter. And honestly, I've gone from my initial reaction of this is terrible to, I mean, it's still, I think, going to affect my personal business because I deal with first-time home buyers, but I think what it's going to do is it's going to keep interest rates down, and I think that's a long-term win. I think by lowering the amortization from 30 years to 25 years, what that's going to do is it's going to make it tougher for people to qualify. It's tougher for people to qualify. It's going to keep the house prices in check, which allows the government to keep interest rates low, which is overall better for our economy.
Sure. Well, I think you're right. I think it does. It takes some of the immediate pressure off. It seems like policymakers are grasping for any kind of levers that they can use to try to. They've got these competing interests, right? They see that housing prices and debt loads have increased quite a bit. I was telling my staff today, you know, when I started 10 years ago, my average loan amount here in Edmonton was $100,000, and GDS and TDS was 32 and 40, and a hard stop at those numbers. There were no exceptions, none of this 44 business. We had to work to get deals done, but our loan amounts were so much smaller that. I think incomes were allowed for it. So, you know, there's a competing interest of trying to keep debt from getting out of control and maybe not putting fuel in the fire when it comes to housing prices, but at the same time not really being able to raise interest rates as much as they'd like because of the fact that we're in an environment that's largely dictated by the United States. They can't raise their rates right now. There's risk of slowing down the economy too much if rates go up. And you know the effect on over-leveraged borrowers. So it's tough. I respect the conundrum that the policymakers are in. I guess it probably reinforces that maybe we shouldn't have done any of this easing 5 or 6 years ago and increased amortization periods. Do you guys think that was a mistake, increasing periods back in the day, or?
Well, we touched on it again. I mean, that was kind of before I was in the business. When I first got into the business, we were sitting at 35 years, and you know, the majority of the business that I wrote, again, first-time home buyers, right? A lot of it, they would be going to the maximum amortization. So there was it was a bit of a shift there. I think it had more of an effect then as what it would now. Yeah. Rates are lower now, right? As much as you know, we talked, you know, about a few years ago how whatever the rate was, 3.69, 3.89, we thought that was a low rate. You know, now we're qualifying on a shorter amortization with even lower rates. So there's still some room there.
There's got to be room. I think there's got to be, and I think, you know, somebody on my team mentioned earlier today that they think maybe it's just people's expectations about what a first-time home looks like might be different now. Maybe it's a townhome instead of a single-family dwelling. Maybe it's an apartment condo instead of a townhome. maybe the expectations on just what can be done in terms of your first property need to be adjusted a little bit, and people may learn to be more patient as a result. Don't you think?
Mm-hmm. Yeah, I definitely agree. I definitely agree with that.
Yeah, no, I totally agree. I mean, being in Regina, Saskatchewan, I mean, my market is pretty interesting. I've seen, you know, I mean, a year ago you could get into a starter house for $250, and you know, it needed some renovations. Now there's pretty much nothing under $300. That's, you know, to expect a first-time home buyer to save 5% down, you know, and then legal fees, while rents are extremely high. I mean, we've got a 0.6% vacancy rate, so I mean, there's no wins there for, you know, people saving money. To save the down payment, not have any consumer debt, and to get into a house that needs renovations, I don't know. It's, you know, these rules are going to make it tougher for those people to qualify, but I think overall in the economy, and from what I hear, it's probably a good move. At least I think the rates will be lower. That's the only real bright thing that I could say for my clients right now is rates will be lower for the next couple of years, what I see.
Yeah, there doesn't seem to be any pressure on those going up anytime soon.
No.
Guys, talk to me about how difficult this must be to set policy at the federal level for dealing and the difficulty that poses to individual markets, because we all know real estate is local. There are different fundamentals in Regina, different fundamentals in BC and Vancouver, different fundamentals in Edmonton or Toronto. You know, it's really a mixed bag. So how does this broad brush approach work when you're trying to set policy? Some areas of the country for sure are doing better than others. Some have had, you know, maybe they've spent the last 4 or 5 years increasing values. I know in Edmonton our values have been moderating for the last 5 years, so we don't feel like there's a huge, and we've got the lowest unemployment rate we've had since 2008. So we've got these positive forces working for us, and we don't really see the problem. So any idea of moderating the housing market here seems kind of silly. Talk to me about how you think that these federal changes apply on a local basis.
You want me to take? I can take that one first. I mean, obviously, being in Vancouver, yeah, it's probably going to have more of an effect, obviously, here, I think, than maybe other places like, you know, Saskatchewan, where the house prices, the average house price, aren't as much. You know, I guess maybe the big change, it won't affect a lot of the business that I wrote, was, I guess, the maximum purchase price of $1 million in terms of being able to qualify for CMHC mortgage insurance. That will I think have the desired effect of kind of cooling down the market here. That's what the finance minister wanted to do, and I think it's going to have the effect I think that's intended in this market for sure.
Okay.
We've already been kind of seeing a lot of a slowdown anyways. I wouldn't say slowdown, but we've definitely seen some moderation.
Some correction, right?
Correction, yeah.
Actually, that's another good question. Do these sort of changes, that they come a little bit too late, or aren't we already seeing? I've been reading reports about households moderating their debt levels and starting to pay off some debt, and the growth rate of debt increases may be slowing. Maybe that's a kind of a funny statistic, right? The growth rate of debt increases is lower, but that doesn't mean debt is decreasing. It just means we're adding it on at a lower rate. Are these changes, are they timely? Are they a little bit too late to the party? Are they just going to cause the pendulum to swing too far to the other direction?
Well, I mean, the way I see it, and I don't know if this directly answers that question, but I mean, it's funny. I think Canadian, you know, policymakers make decisions based on what's best for Toronto and Vancouver. You know, being in, you know, I'm not trying to complain or anything, but I was listening to you know, kind of a broadcast by a couple of Quality Verico guys, and the comment was made. It's like, well, we got both sides of the spectrum here. We got a guy from Toronto and we got a guy from Vancouver, and it's kind of like, really? That's it? That's the whole spectrum? You know, but the one guy made a good comment. It's kind of like saying, you know, setting financial policy in Canada is kind of like saying, what's the weather like in Canada?
Yeah.
Well, I mean, it's going to be completely different from, Nova Scotia, where, rural Nova Scotia, rural Saskatchewan is going to be way different than downtown Toronto. But how do you set policy across Canada that's not going to, you want to really hit your big cities? And, well, I think that if the goal was to slow down the growth in big cities, perfect. It's exactly what it's going to accomplish.
Yeah. So now, I presume that it may be other mortgage brokers tuning in to watch this. It may be for the consumer, so I don't want to exclude one over the other. But talk to us from a broker standpoint. Do you guys see any opportunities in this for our business? I know a lot. I would suspect there are brokers across the country who are wondering how this is going to affect them, if it is going to make it more difficult to be in business. I don't particularly see it that way. Do you guys have any thoughts on the silver lining in all of this for you or your clients?
I mean, as myself as a broker, I mean, I see opportunity. I mean, just because the amortization is lowered for a CMHC insured mortgage, there's definitely some options that we can present that will bypass these with other lenders. With we're still getting 35-year amortization. We always were. It's just a matter of getting the public educated on that. And from the broker side, it's knowing your products, knowing your policies, and knowing the lenders that are out there, and being able to leverage those for your clients. Definitely. I think with these changes, even more opportunity for myself.
Okay, very good point. Very good point. Jackson, anything to add to that?
I think what this is going to do, and I think anything, when rules tighten and things become, the media gets on it and everything gets advertised and exploited, I think what it's going to do is it's going to create more awareness in the public, and I think awareness in the public means that clients are going to be better educated. They're going to say, hey, what are these recent changes? And they're going to seek out people that are knowledgeable. I think that if we continue to position ourselves as educators and we take care of our clients and we, service our clients' need in the way that, we need to, and we are that source of information, we can explain things. I think if people are more diligent in, going out and educating, and they're not just, oh, hey, I should buy a house, and then what can I do now, and then buy a house tomorrow, but they actually sit down with a financial plan, they talk with us, they work through a budget, and we say, okay, in a year's time, if you've saved up this, given this parameter, you'll be in a good financial position to buy a house. I think it will allow the good brokers to do better work. And on the other side, I think what you're going to have is you're going to have the brokers who maybe don't command the same, ability with lenders and products and knowledge and ability to help their clients. I think those brokers are going to suffer, and we might see some of the, part-time brokers exiting the channel, and that'll just, I think, increase the integrity of our business.
Yeah, we probably all agree that the more educated brokers, that's just good for the consumer, that they get the advice that they need. I think this does create that demand you talked about, where there's going to be some uncertainty. There's going to be people will be able to read about it online, but they want to know exactly how it impacts them, how it impacts their budgeting. We think, I would imagine that this creates opportunity. If there is a pricing discrepancy between us and what the banks are offering, there may be people who don't qualify by the thinnest of margins. If they're out at the bank branch getting a 3.59 5-year right now, and they don't qualify at that, maybe they will at a 3.19 or a 3.09 or something along those lines. So that'll create some opportunity. There will be a bit of a spillover effect. Of course, as brokers, we always want to be mindful that we're not getting people in by the hair on their chinny chin chin, so to speak, because we don't want to create a problem 5 years from now. On the other hand, there's a demand from those people, or their situations may be looking up, and they may be entering professions where their incomes will increase accordingly, and that kind of thing. So I think each person is going to have to be evaluated on an individual basis, but as a broker, anything where it creates uncertainty, I think we do a better job at explaining some of these things to people than what we're hearing about the bank experience, and that's maybe where that professionalism and the knowledgeability comes in. We're going to have to be right on top of it to help people out. No,
I couldn't agree more. I mean, and even the discrepancy between pricing in in the bank. Actually, I was dealing with a client, met with a client 2 weeks ago, and he was pre-approved at the credit union.
Yep.
And he was at, they had basically done the mortgage, they'd set it up at a 5-year posted, 5.49, and qualified him with a 32% GDS. He qualified for $190,000. I talked with him. I'm not kidding. I said, well, okay, my rate's here, and, I could do this. And I ended up qualifying him for, just under $300. That's a huge difference. He was at a point where he wasn't even going to enter the marketplace, and now he's looking for, something in the, around the 250 range. But that's a huge difference, and I guess that's just education. He actually mentioned to one, a past client of mine. He was talking with his buddy, and he said, I don't qualify for anything. And the guy said, well, go talk to, my guy, and now we've been able to land it, and it'll work out. So.
Wonderful.
That story is not uncommon here as well. It comes down to the knowledge. You're dealing with these. A lot of times, clients are walking into their local branch, and they're not getting the help they need. The people behind the desk there don't know mortgages. They don't, to be blunt. They're probably looking off. Who knows how they're qualifying these people.
Yeah.
Hey guys, while we're discussing this, talk to me a little bit about, do you see any problems for people who have, arising from this? This scenario came up in our office today where we have a client who purchased a home from a builder. And this is an interesting one, because if you bought a home from a builder and you have a possession a year from now, and you qualified for that mortgage on a 30-year amortization, let's say.
Mm-hmm.
Talk to me about, we've got a scenario where the builder asks for a letter. They want to know that this person is qualified. They've removed their conditions. According to the lender, they're qualified, no problem. The decision from the finance department today could cause that contract to be null and void, or not null and void, but difficult to enforce, could it not? Because if they don't qualify at 25 years to purchase that home, my understanding is they have until the end of December. Is that right? For these, for a valid purchase contract to be honored at the 30-year am. What's going to happen to these people?
That's a tough one. I'm actually, without disclosing anybody's personal information or anything, I'm actually dealing with that exact situation. I've got a client where I've issued a letter. They've gone. Their house is actually listed right now, and they're looking to sell, and their possession will be, March 2013.
Wow.
And it's very interesting. Now, when I did the qualifications, it was funny because I did it at 4.5% on a 25-year amortization, thinking that was outrageous. It'll never get to that point. But, it actually might. I never saw this coming. I didn't see the 30 going down to 25, and that's,
that was a sneaky
that's pretty significant when you're looking at this. And I think there's going to be, I think that's not a unique case. If your office is already dealing with it, and my office is dealing with it, I'm pretty sure every office is going to have a couple of cases like this.
So there are a few builders out there who are a little nervous maybe with some of this news. Not to mention the home buyers. At the end of the day, the builder is going to hold that home buyer responsible. I wonder if it's going to put some people in default of the terms of their agreements and cost some people, the deposit on these new homes, or worse, maybe even a lawsuit. So that's a serious issue. And in the past, when we've seen some of these rule changes, things have come up where the department has had to essentially clarify their position on the unforeseen circumstances that come up. I wonder if we're going to see that on some of these issues, a bit more clarification or a few exceptions to the rule, maybe.
Well, if you look at the government, the government issued the FAQs, and the very last FAQ was kind of interesting, but it singled out condos, and it talked about condos with a possession date past 2013, and it kind of, I thought it was, I read it and I was reading it very briefly, but it seemed like it was trying to make that kind of a scenario, but very specifically said condos and didn't really wasn't as clear as I would have liked it to have been.
Didn't touch on new builds. Scott, the condo market in Vancouver, one of the things that came up, and it seems like some of the commentators have said that this is an attempt by the Department of Finance to slow down the escalation in pricing for condos. And when you slow down the pricing on something, you're trying to dry up the demand a little bit. Could it not be that we actually get an unforeseen circumstance here where by making it harder to qualify for single-family homes or townhouses because amortization periods are shorter, is this actually going to drive more people into condos and actually maybe increase the price of condos in the short term? But could it not have the opposite effect as it was intended?
Yeah, I mean, I guess. Yeah. I mean, potentially, maybe could. Yeah, the condo market. This is where it's always kind of skewed. I mean, our numbers in the Lower Mainland are very skewed by, the big single-family dwellings on the west side of Vancouver. Like the prices got so out of line with multiple offers and what the sale prices were going. It skewed the entire market. So when you see the average price, whereas condo market, I'm out in Fraser Valley, which is a suburb of Vancouver. The condo prices have actually remained pretty flat, and if anything, have gone down, depending on this. Again, we're talking about really localized markets, except for certain styles of condos. If you're near a school with a 3-bedroom, those are obviously they're keeping their value more than a 2-bedroom condo. So it's location. Speaking from experience that I've noticed, we really haven't had an increase in price in condos. If anything, it's been relatively flat for the probably past 3 years, and depending on location, even a little bit down.
Yeah, I guess it would be good to have a broker from Toronto on today, because I know that's the hub of all.
That's kind of the new hub of pre-construction seems to be Toronto now. Yeah, Toronto's taken our crown.
Yeah.
So.
Yeah, it'll be interesting to see what happens out there, I guess. So, guys, I think we should probably wrap it up so we don't bore everybody to death. This is really good. This is a really good first run at our Canadian Mortgage Hangout, and I want to thank you again, Jackson Middleton and Scott Dawson. You can find these guys on Twitter at the Kilted Broker. Did I get that right, or is it Kilted Broker? Oh, it's just Kilted Broker. Yeah. Kilted Broker for Jackson, and at SDD for Scott. My name's Gord McCallum at Gord McCallum on Twitter, and thanks, gents. We'll do this again. This is fun.
All right, good stuff, guys. Thanks.
Cool. Fine speech.